Okay, let's just get started. Good morning, everyone. My name is Erez Katz. I'm the CEO and co-founder of Lucena Research. Welcome to Lucena Research. We are a leader in software solutions for the investment professional. Very excited to be with you today. I'm joined by two of my colleagues. My co-founder and CTO is Tucker Balch. He will be presenting the majority of today's presentation. And I'm also joined by John Coulter, who is our EVP of Sales. He will be moderating today's presentation. See, by applying scientific methods to financial data analysis, we have developed a highly sophisticated yet easy to use and affordable solution for small to mid-sized investment firms and other sophisticated investors. Lucena levels the playing field by enabling our customers to exploit market opportunities with precision and scientifically validate investment strategies before risking capital. Now let me pass the microphone to my co-founder and CTO, Tucker Balch, Ph.D., so that he can lead you through today's presentation.
I'm Tucker Balch. I'm a CTO here at Lucena. I'm also a professor at Georgia Tech, and really excited to be working with my colleagues here at Lucena and be able to provide you this technology. Quick overview of the topics we're going to cover. Introductions, we've told you some about us. Going to provide an overview of QuantDesk, our product, our cloud-based product. We're going to have a live demonstration of that, and then we'll wrap it up. So thanks so much for joining us. Now, before we dive in, we have to cover a few disclaimers. We're a technology company. We are not investment advisors. Do not invest any funds you can't afford to lose. And if you're unsure about that, please contact a professional investment advisor. We're going to show you some statistical-based methods and algorithms. Do not assume that these approaches are profitable. And finally, the numbers we're going to show you are hypothetical. They're based on simulated performance, and as such, there's no assertion that they are correct. The market is a big data problem. There's at least 13,000 equities traded actively in North America. If you consider that each one of those equities represents at least 120 technical and fundamental factors that we look at each day, and there's 252 trading days per year, that adds up to a lot of data really quickly. So if you're just looking at 5 years of data, that's 1.96 billion data points. And it's a nearly impossible task for a person to wade through that and to find patterns and understand how to manage their portfolio in the most effective way. So that's where QuantDesk comes in. QuantDesk is big data analytics. It helps you cut through this clutter, cut through this huge amount of data. It's a cloud-based service. That means you don't have to install any software on your computer. It runs within a browser. And it incorporates state-of-the-art data mining based on statistical machine learning. So we've been spending years actually building these statistical methods so that we can present them in this cloud-based service to you. It helps you hone in quickly on market opportunities and also methods for making portfolios you have even better. We use the most well-known, robust, and trusted finance algorithms, all integrated with this statistical machine learning. So how does QuantDesk help you? So it augments your alpha. In other words, we assume that you as a trader or a portfolio manager, you're bringing an insight to the table. You're driving your portfolio. You're able to choose stocks on some basis that are going to provide enhanced return over time. What we help with is we bring quantitative tools to the table to help you fine-tune that portfolio. We can reduce volatility while preserving return, and we improve major performance metrics like Sharpe ratio, volatility, and drawdown. The key here is we're augmenting what you do. We're not trying to drive your methods. We're trying to enhance your already successful approach. There's 5 key products: a price forecaster, a portfolio optimizer, Hedge Finder, event studies, and backtesting. There's 3 of these are available right now, and we'll go through them right now in today's demo. And those are the price forecaster, optimizer, and hedger. Coming soon in the beginning of next year, we're going to roll out the event study and backtester. Okay, let's dive into the price forecaster. So the price forecaster uses technical and fundamental statistical models to create 5, 10, and 20 trading day price forecasts. You can see an example forecast there on the right. This sort of triangular shape shows the forecast, and it's surrounded by upper and lower bounds of standard deviation. The benefits are that this leverages state-of-the-art machine learning directed by you to find market opportunities. And this approach is unique to Lucena. So when you start our product, like I said, it's a web-based product. You'll be provided a login name, which is an email address, and a password. And this represents the products available along the top. And when you log in, you're initially brought to the Portfolios tab, which shows you portfolios that you have entered. You can also create new portfolios. You can upload them, for instance, or enter them symbol by symbol. We're going to go ahead and jump to the Forecast tab. And for forecasts, you can look at forecasts for individual equities within your portfolio, or you can look at larger lists. For this demo, we'll just quickly look at Dow Jones. So when you click on a system list, there you're seeing the symbols that make up that group. And you can click on individual equities and see their chart below. We also provide technical information and also fundamentals that you can look at for each one of those equities. Okay, so let's get now to the forecasting. We use statistical machine learning, and what that does is it builds a predictive model based on your guidance. So we have 120 technical indicators and also fundamental features that you can use in this model. Let me show you real quick, if you wanted to build a model, how you would do that. So we'll name this test model. And down below here, you can browse through the different indicators that are available. Let's say, for instance, that you believe Bollinger Bands are predictive and should be part of a model. You can click Add and add that to your model. Let's say you like RSI. In this section, then we show the features that you've selected and that you think are predictive, and you can tell us how important you believe they each are to a model using these sliders where you set their weights. Once you're done configuring that model, which can include as many factors as you believe are important, and again, these can be technical or fundamental or a combination of the two. you save that model, and we can then use it for forecasting. We also provide, lots of people want, just tell me what the best model is. We also provide a default model that does that. And each week we tune that model to find the best features. Here you can click here and see what those combinations are. Okay, now once you've selected a model, and essentially that is which factors you believe are important, you can then choose to forecast out, let's choose 2 weeks, and you can look back at different time scales from 1 month to 1 year. And what that aspect does is it tells the system how much historical data do you want to go into the model. Sometimes it's better to use just more recent data if the market is changing rapidly. Other times folks like to use further look back. But once you've selected that model, our number crunching goes to work, and we consult that model for each equity, and we present the results in 2 ways. There's a tabular representation where for each equity we show you forecasts of how much it's going to change, and a really nice feature is we share a confidence value where 5 stars is most confident and one star is least confident. So you can sort by any of these columns. You can sort, for instance, by which we think are going to change the most in either direction, or by confidence. So we're, for instance, least confident in TRV. And then you can click on individual equities, and you see the forecast down here graphically. You see how it's performed historically. This vertical blue line here is now, and this sort of triangular section going forward is the forecast. That center line is how much we think it's going to change, and the upper and lower bounds there are standard deviation representing essentially our certainty of that change. Okay, that's the forecaster. So this is again statistical machine learning, and I mentioned that we build models, according to your direction, but furthermore, we build mini models. Each model uses, for instance, the features that you think are important, but we group equities together in 10 groups according to how they move together. So as an example, that graphic on the right shows how our system can segregate equities into separate groups according to how similar they are. So that ensures that the data that goes into a model is from equities that perform similarly. So for instance, financials probably act more similar to one another than they react than technology. So we group technology stocks together, financial stocks together, and that makes the models better. Once we have these groups of equities, like I said, we can consider up to 120 quantitative metrics. A very nice feature that we can provide is the ability to use not just our technical indicators and fundamental measures, but proprietary time series. So if your firm or you personally have your own specific metrics, we can integrate that into our system as well. It turns out that the sweet spot for a number of features to use is about 10 to 15. So we have an automatic method for finding the 10 to 15 best quantitative measures, the ones that, when put together, make the highest quality forecast. So that's an overview of Forecaster. Let's now take a look at portfolio optimization. So what portfolio optimization does, and it's an important part of quantitative technology for well-run funds, is it helps you determine how much of your assets you should allocate to each equity. So if you tell us, okay, these are the 5 stocks, 10 stocks that I want my funds to be in, we can help determine what is the optimal allocation to each of those equities. It uses a Nobel Prize-winning method due to Harry Markowitz. And there are others that offer portfolio optimization. It's called mean variance optimization. What's unique about us is, well, first of all, ours is very easy to use. And second of all, we integrate our machine learning with it. So you can take advantage of the forecast to refine your optimized portfolio. Now, let me dig a little deeper into how this works. Of course, a portfolio, you've heard diversity, diversity, diversity. And what that means is you want stocks that react differently each day to the market. And you might think that when you build a portfolio, well, first of all, let me start by showing you this chart, which is a way to view each equity that's in your portfolio. So each equity has its own characteristic risk and its own forecast return or historical return. So you can graph all these equities on a chart like this to assess them. Now you might think that when you build a portfolio by combining them, that your portfolio will have, say, a risk return structure, say somewhere here in the middle. But the insight that Harry Markowitz had and that we take advantage of is that you can in fact build portfolios that have lower risk than the average of your equities. In fact, potentially lower risk than any of the equities individually. So here's an example where you create a portfolio by weighting these 6 equities. And the risk return profile of this new portfolio is actually, as you can see, lower risk than even the single lowest risk equity, and higher return than most of the individual equities. And this is possible because the optimizer looks at forecast return. It looks at how the stocks move together. That's called covariance. And it also looks at their individual volatility to build that portfolio. Now there's many portfolios you can build, one for each target return. Here's another one. And in fact, something that Markowitz showed, what he got the Nobel Prize for, was to show that all of these optimal portfolios lie along this line called an efficient frontier. And our portfolio optimizer delivers these optimal portfolios along the efficient frontier. And there's 3 important portfolios along there. There's one which is the maximum return, which tends to be actually higher risk, of course. Another is the minimum risk portfolio, which of course provides the least volatility. And finally, there's a balanced one that is somewhere in between. And we allow you to choose between those 3 options when you're optimizing your portfolio. So let me show you that. Let me show you an example of that with our system here. Okay, we'll go to the Optimize tab, and we're going to start with a portfolio that has 4 equities, a bond ETF, gold, the S&P 500, and an oil fund. And it's these are all about equally weighted in the portfolio. So we're starting with equal weights to each of these, and we'll now see what the optimizer recommends with regard to potentially a different weighting. So all of our tabs have the similar layout. You choose which portfolio you want to work on over here, and then you set up the settings you want for the particular feature. So we can create long and short portfolios. We can also create long only or short only portfolios. So that's an important option. Here's where you set your risk level, whether you want the lowest volatility portfolio, balanced, or something that provides a maximum return. The look back period, which you can set, is how far back should we look in terms of historical data to find covariance and volatility and so on to optimize your portfolio. Sometimes you want to look back only a short period, sometimes you want to look back longer period. What What's unique to us and is very important here is one of the most important inputs to the optimizer is where do we think these equities are going? And you have three options here. You can use a historical average, which is the classic method. You can use our forecaster, take advantage of the statistical machine learning, or you can enter your own sentiment, which way you think each equity is going to go. For this example, we'll go with the historical average, and I'll click Optimize here. Now let me make sure everything's sorted correctly. Up here is your portfolio before optimization and the weightings. Here below, you see the recommended weightings after the optimization. Now, one thing to note here is it's recommending a strong investment in AGG. Remember, we selected minimum risk, and it turns out that of those equities, AGG is one of the lowest volatility. It actually wants to short oil because it's observing recently that it's going down, and we allowed it to be a long and short portfolio. Let's look now at the chart representation. This blue line is the historical performance of the portfolio before, and again, you also see a forward-looking cone here of the forecast and standard deviation. Now, after optimization, you can see that it's much less volatile. It provides about the same return. And in terms of forecast return and volatility, it's substantially reduced. Over in this panel here on the right, we highlight the aspect that we were seeking to optimize, in this case volatility. And you can see we provide a portfolio that's about half as volatile with very similar return. Now we can try different methods. Try balanced, which is seeking a balance now between return and volatility. So the volatility is still about the same, but note that the return is higher, and the Sharpe ratio is more than double for this optimized portfolio. Okay, that's portfolio optimization. One of our really unique offerings, and we're not aware of anyone that has something similar to this, is our Hedge Finder. The way this part of our product works is you give it a portfolio. It's a fixed portfolio. You want to hold these equities, but we can ask the system to provide a basket, an additional basket of equities to add to the portfolio that will reduce downside risk and volatility of your original portfolio. This again also exploits statistical machine learning, and the hedge is customized to your particular portfolio. And again, this is unique to Lucena. One thing to point out is a couple things. We hedge using equities. It's not based on options. We find that that provides actually a lower cost method of hedging that also offers return. So some typical hedgers actually take a significant amount of return out of a portfolio. So, and we're finding that we're able to offer reduced volatility and preserve return. Here's a little bit of the underlying science of how that works. In this case, we're trying to build a hedge for this red equity, which actually is the Dow Jones. And this vertical line here represents now, or when the system is allowed it indicates a boundary of where it's allowed to learn and do a statistical search. So we look back in time, and what we do is we try to build a portfolio using our algorithms that reproduces the best hedge. So what is the best hedge? Well, it's this black line here that is, as you can see, it's a mirror of the original equity. It's flipped around the trend line of where the equity was going. We have an underlying technology called portfolio replication that when we give it a time series, it's able to search over thousands of equities to build a basket that reproduces that target portfolio. What we find here, we can't always match it exactly. What we found here is represented with the green line. Now we simulate here entering that hedge, and going forward you can see the Dow had a significant drop, but our hedge reacted positively, and the net result here shown in blue provides a much better overall performance. And we can create tuned hedges like that for any sort of portfolio. Okay, let me show you how that works with our product. So again, we go to the hedge tab, and we'll look at this same portfolio. Again, you choose the portfolio that you want to work with here on the left, and now there's some controls for the hedger that are available to you. One of the first that's very important is we call it the white list, and that's the list of equities that the system is allowed to use to build the hedge. In this case, we're using the Russell 2000 and then a few ETFs. But you can edit this white list as you see fit to add other major indices or specific symbols that you'd like to use. There's another list called the black list, which are specific equities you do not want it to use. So for instance, you might not want to use ultra-leveraged ETFs, and you can add those there. Okay, now one thing that's really nice about the system is we offer not only short-only hedges, which is what most people think of when they think of a hedge. We can actually generate long-only hedges, which that might sound odd, but for many applications, like trying to reduce volatility in an IRA, people are only allowed to go long. So we can find appropriate instruments to hedge even in a long-only situation. For this example, we'll go with long and short. Look-back period, similar to the optimizer. How far do we want to look back? There's two more important parameters here. One is we call it target beta, which is how reactive does the hedge need to be against the core portfolio. So this isn't beta against the market. It's beta between the hedge and the core portfolio. Finally, you can choose what percentage of your portfolio should be allocated to the hedge. So in this case, we're going to go with 50%, but you can choose to use a smaller percentage. Let's say you went with 33%. In that case, you would want your beta to be higher because only a third of your portfolio is allocated to the hedge. That hedge needs to be more responsive to respond to market changes. Okay, let's go ahead and run the hedge. Again, we present the original portfolio in blue there. The new hedge portfolio is in orange. And as you can see, we've got reduced volatility and actually improved return. And we also provide a forecast cone. Again, we're looking at reduced volatility in the forecast as well. I didn't mention, here's the recommended hedge, your original portfolio, and then the hedged portfolio, which has new equities that have been added. Now let's say, for whatever reason, you did not want pharmaceuticals in your hedge. You can click Remove, and it'll remove that equity, and you'll see it's been added to the blacklist over there, and it'll re-hedge. It takes a little bit of time to build the hedge. Remember, it's looking at over 2,000 equities simultaneously and considering millions of portfolios in order to build that hedge. Okay, that's the hedger. And that's completing our technology overview. Let me hand it back to Erez.
Okay, so thanks. That was very. Hopefully, everybody got good value out of this presentation. This is obviously an overall high level. We would like to hear from you later on, suggesting maybe other topics you'd like to cover, maybe more in depth, or other permutations of what we have discussed today. I want to just bring this to the website. That is a great tool to go and find more information about us. We have been updating it perpetually, and you can sign up for a free 30-day trial by clicking on the top right button as indicated here on the screen. In addition, once you're signed up, there's no credit card. There's no need to pay anything. We want to try to show you the value before we engage you on a more permanent basis. The My Account, the link that you see here below the red arrow, gives you access to our web portal. At the web portal, you'll have access to three main documents. The Quick Start Guide, it's a PDF document. The User's Guide, a little bit more in-depth, how to with regards to using our platform. And at the bottom, you'll have another document called the Web Portal document, which obviously presents additional features on our website that are not part of QuantDesk. So that's pretty much what I wanted to share with you on the website. Thank you, Tucker. Well, this is pretty much concluding our session today. We had a very nice turnout of attendees today. We'll reach out to you, or feel free to reach out to us. We will, as mentioned before, create additional webinars that will cover some topics that are more specific to our technology and to the overall needs in the market. And looking forward to hearing back from you and seeing you again on the next webinar from Lucena Research. Thank you very much.